Welcome to The Explainer. After the absolute roller coaster that was 2025, we're going to look ahead and see what 2026 has in store for the global economy and, of course, your investments. The big takeaway? It's looking like a year of moderation, not massive, off-the-charts exuberance.
But hey, before we jump into the future, let's just quickly set the stage. You really can't understand where we're going until you remember where we've just been. And wow, 2025 was a wild ride for the markets. It started off with some serious turbulence, but you know what? It actually ended on a surprisingly high note. I mean, look at this. Even with everyone feeling pretty jittery about the economy, the major US indexes pulled off their third straight year of double-digit gains. You've got the S&P 500 up around 17% and the tech-heavy Nasdaq surging 21%. And this all happened even after a big tariff scare in the spring almost tipped the whole thing into a bear market. What a comeback. Okay, so here's how we're going to tackle all this. First, we'll dig into that big global theme of moderation. Then we'll zoom in and see how it's playing out in three really different economies. After that, we'll do a little storm watching, scout out the potential risks on the horizon, and we'll wrap it all up with a practical investor compass to help you navigate 2026. All right, so the biggest story for 2026, it isn't some huge boom or a catastrophic bust. Nope, it's something a little more subtle, but honestly, way more important. It's a fundamental change in what's actually powering the global economy. This slide right here really gets to the heart of it. For years, markets are basically supercharged by central banks printing money and keeping interest rates super low. That whole quantitative easing playbook. Well, now the baton is being passed to government spending. So yeah, we might still see some rate cuts, but that whole era of easy money that fueled those massive rallies, that's behind us now. And this quote from Nyla Shah just says it all, doesn't it? It's the core message for every single investor out there. After the amazing run we've had, it is absolutely crucial to reset our expectations. The game has well and truly changed. So what does this big global theme of moderation actually look like on the ground? Well, let's explore it by looking at three totally distinct economic stories: the powerhouse US, the resilient emerging market of India, and the diversifying success story that is the UAE. This table really breaks it down nicely. You can see the US is going all in on AI, but there's a real risk of a bubble. India's big strength is its domestic market, but they're worried about private investment slowing down. And the UAE, it's firing on all cylinders with its non-oil sectors, but it's still got to worry about a global slowdown. Let's kick things off with the US. Right now, the entire economic story there is just dominated by this incredible, almost feverish enthusiasm for artificial intelligence. All that AI spending has pushed markets to record highs, but the fear is growing that tech valuations are just stretched way too thin and a bubble might be forming. And to put that concentration into perspective, get this: just 5 companies, NVIDIA, Apple, Microsoft, Amazon, and Alphabet, now account for almost 30% of the entire S&P 500 index. That is a staggering amount of weight resting on just a handful of stocks. Okay, let's shift gears and head over to India, which is a whole different story. It's still a major bright spot globally, super stable after a decade of big reforms. But even here, you can see that theme of moderation as it kind of settles into a more mature, mid-single-digit growth phase. But here's a really important detail. While the overall economy is moderating, the corporate world is telling a different story. See, after 6 straight quarters of single-digit growth, earnings for India's top 50 companies are actually expected to bounce back into the double digits in 2026. So that's something to watch. And for our final story, we've got the UAE, which is just a powerful example of how to diversify an economy. The whole narrative here is about their successful pivot away from relying on oil and building a much more robust, multifaceted economy. And I mean, the numbers really do speak for themselves. The UAE's economy is projected to expand by a very strong 5.3% in 2026. And this incredible forecast is built almost entirely on the back of its fast-growing non-oil sectors. And what's really impressive is how broad that growth is. It's not just one thing carrying the load. We're seeing really balanced expansion across all these key industries. You've got financial services, construction, real estate, manufacturing, and a tourism sector that's just booming. Okay, so of course, no forecast would be complete without a little bit of a storm watch, right? Every outlook has its uncertainties, and there are several pretty significant risks out there that could definitely disrupt this whole picture of global moderation in 2026.
Yeah, investors have a lot to keep on their radar. There's that huge question. Is the AI boom a real revolution, or is it a bubble just waiting to pop? The ghost of inflation is always lurking, especially if this de-dollarization trend picks up steam. Geopolitically, the US-China rivalry and the threat of new tariffs create a ton of uncertainty. And then there's a huge one for the markets. A leadership change is coming to the US Federal Reserve, which raises some real questions about where monetary policy is headed. So, after all that, what does this actually mean for you and your money? Let's take this whole global forecast and distill it down into a clear, actionable investment philosophy for the year ahead. The big takeaway here isn't to be pessimistic, it's to be realistic and strategic. The goal for 2026 is all about building a resilient portfolio that's designed for a totally different kind of market, one that's going to reward steady progress, not just speculative home run bets. So in a nutshell, the winning playbook for 2026 is really about patience and discipline. It means lowering your expectations for those huge returns, making sure you're diversified, focusing on solid, long-term fundamentals, and looking for growth opportunities beyond just the usual big tech names. So, we'll just leave you with that thought. In an environment that looks so different from the last 5 years, clinging to old strategies, well, that might just be the riskiest move of all. Thanks for joining us for this explainer.